Welcome to the deep dive. Today, we're pulling back the curtain on one of the most iconic figures in finance.
Mhm.
We're not just talking raw numbers here, though. Well, there are plenty of those.
Definitely are.
We're embarking on a deep dive into the latest annual letter from, a real titan of industry. We're looking to extract some vital lessons on leadership, long-term thinking,
Yeah.
maybe even find a little unexpected humor.
Right. Think of it as your shortcut to understanding the core philosophy.
Exactly.
And for this deep dive, our sources are direct excerpts from Berkshire Hathaway's 2024 annual letter to shareholders.
Okay.
Our mission, really, is to pull out the most important nuggets of knowledge and insight.
Yeah.
Make sure you understand what truly matters without getting, bogged down.
Yeah, avoiding the overwhelm.
Precisely. And what makes this source so interesting is the letter's own style. It's very conversational.
It is, isn't it?
It's written almost as if the roles were reversed. Like the CEO was a passive investor, trusting you with their savings and telling you exactly what they'd want to know. It sets a fantastic tone. Very transparent.
That conversational style, it leads us right into, I think, maybe the most refreshing aspect of this letter. The unvarnished truth.
Absolutely.
I mean, annual reports often have the mandated facts, but this one goes so much further. It gives you commentary about what you own and how we think.
Yeah.
It really invites you into their mindset.
It really does. And the core principle here is radical transparency, especially around admitting mistakes.
Which is where?
Very rare. The letter mentions advice from Tom Murphy given like 60 years ago. Praised by name, criticized by category when you're discussing problems.
Good advice.
Isn't it? And the author doesn't shy away from his own errors. He says, sometimes I made mistakes in assessing the future economics of a business. Each a case of capital allocation gone wrong.
Wow. He just puts it out there.
Right. Applies to marketable equities, 100% acquisitions, the lot. He even admits mistakes in assessing managers, noting that fidelity disappointments can hurt beyond their financial impact. And the cardinal sin, as Charlie Munger apparently called it, is thumb-sucking.
Thumb-sucking.
Yeah, delaying the correction of mistakes.
Oh.
He points out that between 2019 and 2023, he used mistake or error 16 times in his letters.
16 times?
Yeah, whereas many other huge companies, he says, have never used either word over that span. They tend to resort to happy talk and pictures. Amazon's noted as an exception, though.
Interesting.
He even mentions being a director where mistake or wrong were like forbidden words in meetings. Said it always made him nervous.
I bet.
And he introduces Greg Abel, the future CEO, who clearly shares this Berkshire creed of true reporting. You know, the idea that if you start fooling your shareholders, you will soon believe your own baloney and be fooling yourself as well.
That level of transparency, it's more than just, good ethics. It feels like a strategic advantage.
I think so.
It signals that the leadership confronts reality, which has to be foundational for trust and, well, just making good decisions long term. You mentioned how rare this is. Why do you think other companies avoid it? What are the real risks or benefits here?
Well, often I think companies worry about perception, right? The market, competitors, maybe even their own people. There's this cultural pressure in many places to always project perfection.
Right, keep up appearances.
Exactly. But like the letter implies, that can slide into self-delusion pretty fast. The benefit for Berkshire, it's huge. It builds this culture of trust, of honest assessment. When you openly admit errors, you empower everyone else to do it too. That means faster corrections, better decisions overall. It's a long game based on trust.
Building on that honesty, let's look at how it plays out with people. That trust seems to extend to the individuals they find, often in ways that really challenge conventional thinking.
Definitely.
The letter gives this amazing anecdote about a man most shareholders wouldn't know, but who contributed many billions to their aggregate wealth. Pete Liegl, founder of Forest River, an RV maker.
Oh, this is a fantastic story. A brilliant example of unique leadership spotting and what they call a winning decision.
Okay, tell us.
So the acquisition was back in June 2005. Pete Liegl wanted to sell specifically to Berkshire, and he just stated his price directly, no messing around, which was apparently really appreciated, that no-nonsense approach.
Straight shooter.
Totally. And what's even more unusual, during the talks, the author accepted Pete's valuation of the real estate without even getting an appraisal.
Really? Just took his word for it.
Seems so. But here's the kicker. When they asked about his compensation, Pete paused, then said, well, I looked at Berkshire's proxy statement, and I wouldn't want to make more than my boss, so pay me $100,000 per year.
Get out. $100,000
Or-
for running what became a multi-billion contributor.
That's the story. And he added a bonus request. But we will earn X. And I would like an annual bonus of 10% of any earnings above what the company is now delivering. They apparently had a sort of vague agreement on adjustments, but it never caused an issue.
And the outcome?
Pete shot the lights out. That's the quote. For 19 years, no competitor came close to his performance.
Incredible. What a story. It really underlines that lesson about finding and trusting talent, doesn't it?
It does.
And speaking of finding talent, the letter drops another bombshell, really. A totally counterintuitive hiring philosophy, formal education, apparently irrelevant.
That's right. Explicitly states, I never look at where a candidate has gone to school. Never.
Wow.
He gives examples. Pete Liegl, obviously. His friend Bill Gates didn't finish college. Charlie Munger's business manager, Ben Rosner, apparently never went past 6th grade.
Seriously?
Yeah. The belief expressed is that a very large portion of business talent is innate, with nature swamping nurture.
Nature over nurture?
Pretty much. The letter emphasizes that a single winning decision can make a breathtaking difference over time. Points to Geico as a business decision, Ajit Jain as a managerial one, and Charlie Munger as, well, a one-of-a-kind partner. It's about spotting that innate genius.
So this isn't just a nice story about gut feelings. It's a direct challenge, isn't it? Are we over-indexing on credentials when maybe innate talent and character are what really move the needle?
It certainly makes you think.
What does this suggest for how we usually find and develop talent?
Well, it implies we need to look beyond the CV, you know. It suggests that while school gives you a foundation, it often doesn't predict that entrepreneurial spark or the ethical core or the unique problem solving that makes a real leader.
Right.
It suggests focusing more on practical experience, how people handle real challenges, how they adapt and innovate, not just their degree. It's a strong case for valuing different paths and inherent ability.
Okay, from identifying talent, let's shift to the numbers, because as you said, there are plenty of those and they tell quite a story. Let's get into Berkshire's overall performance.
Right. So 2024, Berkshire actually did better than expected. That's despite 53% of their 189 operating businesses reporting a decline in earnings.
How did that happen then?
Well, it was significantly helped by a predictable, large gain in investment income. Treasury bill yields went up, and they held a lot more of those short-term securities.
Okay.
Their insurance business also had a major earnings increase. Geico especially, which Todd Combs has been reshaping, boosting efficiency, updating underwriting. Not done yet. But the letter calls the 2024 improvement spectacular.
High praise.
Definitely. And property casualty insurance pricing got stronger, reflecting more damage from convective storms. There's even a subtle nod to climate change announcing its arrival as a factor there.
Interesting they mentioned that.
It is. And their big railroad and utility operations also improved aggregate earnings. So all told, operating earnings hit $47.4 billion in 2024. That's up quite a bit from $37.35 billion in 2023.
And that's the number they focus on?
Yes, they emphasize operating earnings over the GAAP mandated number. That's generally accepted accounting principles because GAAP includes volatile capital gains or losses, which can swing wildly year to year. Got it. Those are impressive numbers, but here's something truly mind-blowing that ties into them. Berkshire apparently smashed a major American record.
Oh, yeah. This is an incredible part of the story. It's about transformation. 60 years ago, 1965, when current management took over Berkshire, it was described as a mistake. A failing textile company headed for extinction. Paid not a dime of income tax for a decade.
Right, the classic origin story.
Exactly. Now, fast forward to 2024. That same company, Berkshire Hathaway, paid, get this, $26.8 billion in corporate income tax to the U.S. government.
$26.8 billion.
Billion, which is, quote, far more than the U.S. government had ever received from any company, even more than the tech titans worth trillions.
That's staggering.
It amounted to about 5% of what all of corporate America paid. To try and picture it, the letter says, if Berkshire had sent the Treasury a $1 million check every 20 minutes throughout all of 2024, we still would have owed the federal government a significant sum at year-end.
Wow. Just, wow. How, why so much? The crucial factor, reinvestment. Berkshire shareholders during that whole 1965-2024 period got only one cash dividend, a tiny $101,755 back in 1967.
One dividend in 60 years.
Basically, yeah. They endorsed continuous reinvestment. That's what allowed the company to build up its taxable income to such a huge level. Aggregate tax payments are now over $101 billion. It's held up as a powerful example of the American miracle of savings and compounding.
That record tax payment, it really highlights the power of that long-term vision, doesn't it?
Yeah.
Consistent reinvestment, not just for the company, but impacting the whole economy. It's compounding on a national scale.
Absolutely.
So with all that capital being generated and reinvested, where does it actually go? The letter talks about an ambidextrous investment strategy. What does that mean?
Right, ambidextrous, meaning they do two things at once with their equity investments. So on one hand, they own controlling stakes, usually 100%, but at least 80% in 189 subsidiary businesses, valued at many hundreds of billions. This includes, as the letter says, a few rare gems, many good but far from fabulous businesses, and some laggards.
A mixed bag, then.
Kind of. And the challenge here is they have less flexibility to sell if they made a mistake. They rarely sell controlled businesses unless there are just unending problems.
And on the other hand,
The other hand holds marketable equities, a small percentage of a dozen or so very large and highly profitable businesses. Household names like Apple, Amex, Coke, Moody's. These were valued at $272 billion at year-end.
more liquid, I guess.
Exactly. It's easier to change course if a mistake is made, although Berkshire's sheer size makes even that tricky sometimes. But the flip side is, with these minority stakes, they can't change management or dictate capital allocation if they're unhappy.
Right. They don't control those companies.
Precisely. And the choice between these two paths, it's impartial, based purely on where they think savings can be best deployed. Greg Abel gets a mention for his ability to act when opportunities pop up.
Okay, so what about all the commentary about their huge cash pile?
Ah, yes, the extraordinary cash position. The letter actually addresses this directly. It clarifies that the great majority of your money remains in equities. That preference won't change.
So the focus is still businesses, not cash.
Definitely. They state the value of their non-quoted controlled businesses is actually far greater than the marketable stock portfolio. The core belief is clear. Berkshire will never prefer ownership of cash-equivalent assets over the ownership of good businesses.
Why such a strong preference?
It ties into a broader economic view. Quote, paper money can see its value evaporate if fiscal folly prevails. But businesses and individuals with needed talents can generally cope better with monetary instability.
Makes sense.
The system, capitalism, it has its faults and abuses, the letter admits, but it also can work wonders unmatched by other economic systems. America is Exhibit A. Savings and smart deployment of capital are key.
That's a really deep insight into how a company this size manages wealth. It definitely makes you think about your own approach, right? What do you value? Long-term flexibility, liquidity, or maybe sustained growth, even if it's harder to change?
Good questions to ponder.
Now let's shift gears slightly and talk about Berkshire's core business, property casualty insurance, or PC. It's a unique model, often misunderstood. How does the letter explain it?
Right, PC insurance. Described as rare, very rare among giant businesses. Because usually companies incur costs before or around the time they make a sale. In PC insurance, you get paid up front, but you only find out the real cost of your product much later. Sometimes, the letter says, a moment of truth that is delayed as much as 30 or more years. Think asbestos claims from 50 years ago still being paid today.
Wow, okay, so that creates the float.
Exactly. That upfront cash you hold before paying claims is float, and insurers can invest it. But there's a huge risk. A company can be losing money, sometimes mountains of money, before the CEO and directors realize what is happening.
Especially with those long-delayed claims.
Yes, especially in long-tail lines, where claims take years or decades to resolve, like medical malpractice. The letter warns the accounting can be particularly dangerous if the CEO is an optimist or a crook.
An optimist or a crook. Strong words.
They are. Berkshire's strategy. Aim for a small underwriting profit while investing the float. And so far, their estimates for future surprises have been okay. They're not deterred by the dramatic and growing loss payments, like from wildfires. They see it as their job to price correctly to absorb those costs.
And Ajit Jain's role.
He's credited with transforming the insurance operation into a world leader, known for both its appetite for risk and its Gibraltar-like financial strength. Compensation helps align interests, too. Managers have big personal investments in Berkshire, no stock options. This encourages caution but does not ensure foresight.
Makes sense. How does economic risk play into this?
Well, PC insurance growth is tied to economic activity and risk. More cars mean more potential accidents. More development in risky areas means more potential damage from hurricanes, wildfires, and so on.
Which relates back to that climate change mention.
It does. The letter also explains why it'd be foolish, make that madness to write 10-year policies for some risks. Auto insurers even shifted from 1-year to 6-month policies to allow for smarter, quicker adjustments to pricing.
So what's Berkshire's edge here?
Capacity, mainly. No private insurer has the willingness to take on the amount of risk that Berkshire can provide. But they also know they need to shrink when prices are inadequate to avoid, quote, corporate suicide.
A balancing act.
Totally. There's a great quote from Mike Goldberg, one of their executives, about underwriters. We want our underwriters to daily come to work nervous but not paralyzed.
Nervous but not paralyzed. I like that.
Me too. So summing up why they like the business. They can handle huge losses financially and psychologically. They aren't dependent on reinsurers, which saves cost. They have outstanding managers, no optimists. And they're perfectly set up to use that massive float for investment.
And the numbers back that up.
Over 2 decades, yeah. Wow. $32 billion in after-tax underwriting profits. And the float grew massively, from $46 billion to $171 billion, all while having a good chance of being essentially costless money.
It's fascinating. A business model that looks simple, collect premiums, pay claims, but it's incredibly complex underneath. Risk, reward, long-term planning. It really shows deep understanding.
It really does.
Now, while Berkshire is famously U.S.-focused, the letter does mention a small but interesting exception, a global move.
Yes. The Japanese investments.
Tell us about those.
So starting back in July 2019, Berkshire began buying shares in 5 major Japanese trading companies: ITOCHU, Marubeni, Mitsubishi, Mitsui, and Sumitomo. These companies actually operate a bit like Berkshire itself, owning stakes in lots of different businesses globally.
Okay, what was the attraction?
Initially, the letter says they were just amazed at the low prices of their stocks. But since then, admiration has grown for how they deploy capital, their management, and their attitude toward investors.
How so?
Well, these companies increase dividends, they repurchase shares when it makes sense, and importantly, their top managers have less aggressive pay packages compared to U.S. counterparts.
Interesting comparison.
It is. Berkshire sees these holdings as for the very long term. They initially agreed to keep ownership below 10%, but the Japanese companies apparently relaxed that ceiling, so Berkshire expects its ownership will likely grow.
What are the numbers looking like?
At the end of the year, the total cost was $13.8 billion, but the market value was up to $23.5 billion.
Nice game. What about currency risk? Investing in yen.
Good point. They address that. To make it currency neutral, Berkshire has consistently borrowed money in yen at fixed rates to offset the equity investment. So while accounting rules force them to show paper gains or losses from currency swings, like a $2.3 billion after-tax gain this year because the dollar got stronger against the yen.
Wait, a gain from borrowing?
Yeah, on paper, because the yen they owe is worth fewer dollars now. About $850 million of that gain was in 2024 alone, but the strategy is actually designed to neutralize that currency risk. Their investment success shouldn't depend on the yen's direction.
Clever. And the income.
In 2025, they expect about $812 million in dividends from Japan, while the interest cost on their yen debt is only around $135 million. So positive cash flow there too.
It's a fascinating move. Really shows an adaptable strategy, right? Always looking for value, even unexpectedly overseas. Challenges that idea that a giant company has to stick rigidly to its home turf.
Definitely shows flexibility.
Finally, for anyone who follows Berkshire, the annual meeting in Omaha is always a big event. The letter gives some unique and personal details about this year's gathering.
It does, yeah. There's a somewhat changed schedule, but the goal's the same. Answer questions, connect with friends, leave people with a good feeling about Omaha.
And sell some products.
Oh, absolutely. Berkshire products will be on sale. Lovable Squishmallows, underwear from Fruit of the Loom, Brooks running shoes, all sorts of things.
The full range.
Pretty much.
Yeah.
But this year, only one book is for sale. 60 Years of Berkshire Hathaway by Carrie Sova. Features photos, quotes, stories about Charlie Munger, and Carrie, who used to work there, refused any payment for her work on this new edition.
Wow, that's dedication.
Isn't it? And there's a unique charity thing, too. The author and Carrie Sova will co-sign 20 copies of the book. To get one, you need to make a $5,000 donation to the Stevens Center, serves homeless adults and kids in South Omaha. And the author is matching all the funds raised.
That's fantastic. Any other changes?
No movie this year. The Q&A will start earlier. Greg Abel and Jeet Jane will join initially. Then it'll just be Greg later on.
Okay.
And there's a really charming personal touch at the end. His 91-year-old sister, Bertie, is attending. He jokingly writes about her claim that her cane stops men from hitting on her. He asks attendees to keep an eye out, betting she'll actually be surrounded by males, like Scarlett O'Hara.
That anecdote about Birdie and the cane, it's brilliant. It really humanizes this whole thing, doesn't it? That often intimidating world of high finance.
It really does.
Does that kind of personal touch show up often in the letters? How does it shape the tone?
It does. Quite consistently, actually. He often weaves in personal observations, stories, even self-deprecating humor. Like, it's very deliberate. It makes the letters incredibly relatable, engaging.
Yeah.
It reinforces that idea of talking with shareholders, like partners. It makes complex finance feel more like a chat with a trusted, kind of witty friend. It's definitely part of that unique Berkshire creed we talked about earlier.
Well, what an incredible journey through this letter. We've gone from that philosophy of transparent leadership to that amazing acquisition story
Pete Liegl.
to record-breaking contributions, those nuanced investment strategies, and then ending with that wonderful human touch.
And through it all, you can't ignore the long-term performance. It just speaks for itself. Berkshire's compounded annual gain, 1965 to 2024, an amazing 19.9%. Compare that to the S&P 500's 10.4%.
And the overall gain difference is just astronomical.
It really is. Over that whole period, Berkshire's overall gain was 5,502,284%. The S&P, 39,054%.
We've seen how these consistent, sometimes seemingly simple principles like radical transparency or unwavering reinvestment or that unconventional eye for talent, how they can lead to truly breathtaking, even record-shattering results over the long haul. It really makes you wonder, doesn't it? What seemingly small, consistent principles could you apply in your own life, your career, your long-term goals? Principles that, if you gave them enough time, just might produce similarly astonishing outcomes.